Hi. In today's video, we'll try to understand the dividend yields. So the question is, can we get rich with dividends? Let's see. So pretty much the investors who are looking for the dividends, they are looking into this part of the dividend yields to increase their return. I'm not talking about the price return. Mostly the price return categories of the investors, they are looking on the growth stocks and they want the stock price to go up. But on the dividend side, these are pretty much the investors who show maybe want a little bit on the growth, but they want the money back, right? As into their invested stocks. So that's what we're trying to focus. So now the question is, okay, what is this dividend yields? So the dividend yields basically the annual dividend per share, right? Usually the dividend can be paid by monthly as well. Yes, it can be paid by monthly, or mostly is quarterly, right? Every quarter, 4 quarter, you get dividend. You just sum it together for per shares. For example, per quarter you'll get, let's say, 25 cents per share. This means there are 4 quarters in a year. So in one full year, you will get 25 times 4 time is cents times 4 is $1. So that's the annual dividend per share basis. And then on the per share, on the market price, what you have bought the dividend, you just divide by that. So for example, if you bought by 10, so we just simply do 1 by 10 times 100 to convert into the percentage and get the 10%. So that's the very good scenario if you get that. But there is quite a confusion or among the investors who doesn't have a broad knowledge of think, oh, this dividend is giving 7%, oh, this dividend is giving let's say 10%, 12%, 13%, and you name it, and these are the good. No. Does it only we have to look on this silo? No, we can easily get burned. Maybe the company is not capable to pay the dividend. How you know? Maybe the company is leveraging from somewhere and just paying the interim, and then soon if it will get bankrupt, right? That's the scenario we doesn't want as the investor as well. We want the companies to be stable as enough, and at least to pay consistent dividends. So that's what are the criteria for it. So I'll give you the 2 examples plus some criteria to like, so you can perform your independent analysis on that. Myself, Pramod Kumar, I am a CFA charter holder and FRM certified. If you're new to the channel, feel free to subscribe and watch. I perform usually stock valuation on my channel, and do please give the thumbs up to this video. I really appreciate that. So given that, let's continue our discussions on dividend yield. So on the dividend yields, one of the major ratio is the payout ratio. What do you mean by the payout ratio? So the payout ratio means, let's say if the earning companies is in the business, sure, they are making some earnings. So for example, if the company is making, let's say, $100 per share, just a hypothetical example, and if the company is giving out let's say the $70 in the dividend, right? That's good. But because the company only need, let's say, 30% in terms of expenses and all. But if the company is the same company can, let's say, if giving is $200 a dividend, that's alarm. Why? Because how come the company is only earning $100 and giving 100% extra $200? Must be the company is borrowing from somewhere to pay it out, or maybe the chances is the company soon will be in the bankrupt, because now, or maybe in the future, they can cut the dividend because the money which they're borrowing right now to pay the dividend, they have to pay the interest on that, and soon also they have to repay back if the company financials are not sound. So that's one of the very key ratio we need to see. Usually the 70% or less should be the good for the dividend paying company, because the dividend paying company, my understanding is, they are into that stage, they are not looking into the growth, they are consistently running and working. So instead of reinvesting into the business where they are unable to generate the good amount of growth, they think, why not just give back to the shareholders? So hopefully that makes sense. So let's take some criteria which I would like to share. The first criteria which I have already mentioned to you is the payout ratio, right? And using this criteria, I'll show you some couple of examples. So the next one, which also need to ensure the company has a history of paying dividend. It's not like the company is paying today but not paying tomorrow and so on, right? That's also, I think, maybe there are multiple criterias we can add to refine your list, but at least I suggest, and at least in my opinion, these are the criteria should be considered, right? So that's just my opinion. The company should have the history as well. It's not like companies newly form and start giving the dividend. Company should be there for a long time, should have a history. So that's my understanding. And at least if I want an equity company to give me the dividend, at least I should see the 4% rule. Why 4%? The reason for my 4% is because mostly the dividend paying stock taken by the people who are closer to the retirement. So rather than investing in the treasury yields or the corporate bond, maybe because right now is a low interest rate environment where they get like a 1%, 2% return, they're thinking, why not I'll invest in the stable company where I'll get the money back so they use that money to pay their monthly expenses. So that's what the scenario I'm right now thinking. Maybe there are some other and why 4%? Usually the 4% rule is for the retiree, they from the portfolio, that should be their the 4% should be their expense. So let's say if the 1 million is the portfolio value, every year they withdraw like a 4% of that, of 40,000, to cover their expenses, right? It can be up and down, but that's the general rule of thumb. Now that maybe there are certain group as well, or different group, I don't want to cover all the group, but that's what I get this 4%. And if it's lower than 4%, my understanding is why take the risk to invest in the equities, especially in the single stock. Is better to invest in even in the gold or some ETF or in the corporate bonds, high investment grade corporate bond, right? Where at least you know that the company, that the bond will pay you that, and you'll get easily 2-3%, or even if you go very risk free, the virtual US Treasury is the key, right? Where you'll get 1 or 2% there. So why invest in equity? So that's my opinion there. Large cap. Why large cap, right? Again, the large cap is, it's easily proved, especially the company over 10 billion and over, because right now these days I think any company who come and these companies must be, for example, utility companies, right? Or the REITs, right? Or the telecom companies. They have a heavy infrastructure plant and machineries where these usually these kind of a company give the dividend. And last but not the least, the earning, they should be at least making some profit consistently, or increasingly, then even is better. Then if increasing profit, we can see that the share prices also go up. But given that, let me give you two examples. This is just a two example, nothing to pitch anything, but using this criteria, you can find some other company for your dividend profile as well. So let's see. Okay, I'm on the Yahoo Finance page, and here I have pulled out the AT&T stock, right? So in the AT&T stock, we know is a very big telecom company. Just want to give, you can just ticker is T. We can easily see this is at over $202.34 billion company. The PE ratio is not that expensive, it's 18 point something, and the price target is 31, but right now the share price is under the target price, right? And if the next dividend days is January 8th, which is soon coming, if you go to the stats, right? Go to the stats, and if in the stat, just search for the dividend, right? Dividend yield, and you see the trailing annual dividend yield is 7.17%. And tada, you see, this is a big company. This is, everything is good, but bear in mind, right? The dividend is over 4%. But what the important ratio I have covered in the separate slide, right? Look at the payout ratio here. The payout ratio is 137.5%. And for me, this kind of a company is big no, because it clearly says the company is paying almost close to over 40% of its earning, right? 100% to cover its earning, but it's paying 100 and almost close to 40%. So if we don't do that kind of a due diligence, then easily get caught by this. I'm not saying maybe the next year it will be better, but at least for initial scanning, as for the example, this is a good company, but as example, just based on those criteria, doesn't looks like a good, and then we should go on to the next company. And another category, same sector, I'm just going in the telecom sector. Let's go to the Verizon. Verizon is and right, if I go to the summary first, it's another it's $244 billion company, right? This company is also paying dividend. Right now it's under its 1 year target. The target price was 61.84, and but the price is 58.98 right now. If the PE ratio is still low, 13 point something. If I go to the stats here, right, and again I'll search by the dividend yield, you see the dividend yield is 4.16%, and if I take the last 5 year is 4.42. So this is amazing, right? It's over 4% dividend yield. That's the good point. But also another good point is, if you already looked into the next line, is the payout ratio is only 55 or 56%, right? Just over half. Amazing. And also, if I usually in my channel, I do the stock valuation, and if you go and watch the Verizon and the AT&T, I did a very deep valuation of these, and on the Verizon is a 5G stock, so we know that's the upcoming market, so that's pretty good as well. So that's from that perspective, just from the dividend perspective, and I think that okay, if we have two securities, which one to pick, right? So we'll take this. And even if this price is increasing, right? So let's say if the price, now the next question is, what will happen if I brought at $100 but the price increased? For sure, but my book value, if I compare with my book value, and with the dividend, if the company is paying the same dividend, my dividend yield stays the same, right? But if I take the existing market price, for sure then the dividend price is less. But given that as a buyer or investor on this share, is I'll get from the price return. Like, let me show that to you, right? So this means my dividend yield is consistent because of my book value, but if the price increase, I'm also earning here, which is another positive sign, right? So, and then my total return also increase. So pretty much that's it I want to cover on this video. I like to say thank you, happy holidays, and if you're new, please subscribe and like and comment which one is your favorite stock and what other topics you want me to cover in this channel. Thanks for watching, and bye for now.